trade in. Okay, I'll come to all of that. There are a lot of questions coming, so I will take the questions later, and probably I will go into a couple of more slides. So right now we have risk management, then we have strike price selection, then how I do the market analysis. There is one slide. Then how do the entry, how do I exit, and how to hold the winning position, and how why do I think market does something when it does. So these are the things that are pending to cover. I think I'm not used to talk for very long, so I'm not sure if I will be able to complete for 4 hours. Maybe after 30 minutes or something, we will break and we'll do another the continuation next week or something. But I will cover some more, and probably I'll try to take at least few questions today and remaining tomorrow, or remaining in the later sessions. Okay, so here I will go to the next slide, which is strike price selection. So strike price selection, it is important, but it is not too important as long as you're trading in at the money or in the money, because certain times, yeah, it makes huge difference. Maybe on an expiry day or day before expiry day, well, it makes huge difference. And certain times it is not that significant. Maybe if you're trading on a Friday, then I prefer to trade in a ITM or ATM on such days. If you are trading on OTM and holding for longer, and if you're not getting the movement, it will give you some loss. So there are two types of trading I do. One is non-directional, one is directional option selling, and option buying, and I do only directional. So directional option buying, it is very easy. I think I've told you already how I select the strike prices. Mostly I try to trade in ATM or slightly ITM, and certain times maybe let's say Bank Nifty trading at 45,200. Most of the time I prefer to trade in 45,200, 300 or 100 options. So these are the ATM or one strike ITM or one strike OTM. So that is what I mostly prefer to trade most of the time. Expiry day it's difficult because I prefer to trade in ITM when I do the direction buying. And when I'm expecting a big move, I go for OTM. Like market is trading at 41,200. And if I'm expecting a very good move, I even trade in a 41,500, 44,500, sorry, 45 is what we were talking, right? Certain times I prefer to trade in 45,500 or even 46,000 also. Certain times if I'm expecting if there is a trigger and if there is a huge move which is expecting, I even go for far OTM also. But usually it is okay to stick with ATM or one strike here or there. That is the better thing in terms of the risk reward ratio for an option buyer. Because ATM, when the market moves 200, 300 points away, 200, 300 points in your favor on an expiry day or day before expiry, it mostly doubles. And on other days also it gives handsome return. So that's why ATM is most beneficial for directional option buying. And directional option selling, I prefer near OTM. Like if the market is trading at 45,200, so I prefer to sell 45,100 or 45,000 usually. And if it is a like proper directional trade and if there is no buying conviction because of the high premium or something, then I sell even little ITM also. I don't sell deep ITM, but slightly ITM and all I do sell many times. So during the high VIX, keep distance equal to the ATM option price. Like if the volatility is very high, the VIX is like 15, 16 and all those times the market is wildly moving, right? So imagine on a Monday, the at the money option is trading at 300 rupees. So I try to keep at least 300 coins away option and sell that. Like market is trading at 45, 300. I prefer to sell about 300 coins away, which is like 45,000 put or 45, 600 call. The reason being at the money option price, which is like 300 points, that can be a little comfortable cushion. It is not that it is a safe cushion, but for me as a person, it is comfortable. We can find your comfort there, but I prefer at the money options price as a cushion. And for non-directional selling also, that is the similar thing I do. Either you can look at the ATR, which is average true range. That will be approximately in line with an option price on a Thursday expiry. Weekly options, the ATR could be almost equal to the Friday option price. So average true range, let's say the average true range is like 600 points. I prefer to pick 600 points away call and 600 points away put, but depending on the day, it may not help you. Like if the ATR is 600 points and on an expiry day, if you are selling 600 points away options, it doesn't make any sense because it will be like penny options. For Bank Nifty, it could be like 15 rupees, 20 rupees, or even 10 rupees, 600 points away. It doesn't make sense to sell such a cheap option. So more than ATR, I prefer to keep the straddle premium distance. Let's say at the money options, call is trading at 200 rupees, put is also trading at 200 rupees. Like the combined premium is 400 rupees. So when I do the non-directional selling, I prefer to sell around 400 points away. In that case, in another day, if the straddle price is combined, the straddle premium is like 600 points, I sell 600 points away call, 600 points away put. And if it is confusing, you can listen to it again and you will understand it. Probably I will open the NSE option chain. You can see my screen, right? So this is the NSE option chain. I'll take Bank Nifty. So in this case, if I'm doing Bank Nifty options, the strike is like 44,900 is the at the money right now. 44,900. The combined premium is 250 plus 265, 315. 314 is the 300 rupees. Approximately 300 point is the straddle premium. Sorry, not 300, 500. Approximately 500 points is the straddle premium. So 500 points away, which is like 44 400 put, and for 500 points away, which is like 45 300 calls. Like maybe I'll take one more strike away because 44 925 is the price. So I will sell 45 400 45 400 call and 44 400 put, which is like ideally equal price, like 87 rupees and 85 rupees. So even if the market moves approximately 500 points, it will not be in the money. It will be still approximately maximum at the money. It will still give you losses, but if the movement is like within like 200 300 points, it will give you profit. So that's why I select the strike prices. And again, remember one thing: my non-directional selling is not my bread and butter. So when I sell non-directional, like imagine I'm selling this for 87 and selling this for 85, and the market starts moving wild, and this combined premium is going more than my cost, which is like 170 rupees. The combined premium is like 170, 180. If it is increasing, then I exit. I'll book losses. Whatever loss comes in, I'll book, and then I'll look for directional buying opportunities, because your non-direction trade is not going good means market is little wild and it is giving the buying opportunity. Market is good for directional trades. Then I look for that kind of trades. So, but while waiting for that kind of setup, if I'm doing any non-directional selling, I do this way. I pick up the strike this way. So you can go back and check that again. If this is not clear, then it will be understood. And this is my motto: cost of being wrong should be less than less than. So your cost of being wrong should be less than the reward for being right. That's one thing I keep in mind while selecting the strike prices. Because when you select a wrong strike prices, like for a directional option selling, if you keep selecting the far OTM price, far OTM options, you gain very minimal amount while winning. But when the market is moving against you, it may give a pain also, right? So that's what. Depending on the situation, you need to pick up the strike price. But for buying and all, as long as you're trading in ATM or ITM, most of the time it will be okay. It is not going to trouble you. And OTM, when you're expecting a huge move, and when you're doing the scalping trades and small movements, do maximum ITM. That's the only thing I think we need to consider while doing the strike price selection. Selling it is much more important. Okay, probably I will cover this slides more. Then we will stop and we will do the remaining probably next week because my energy level is dropping. I'm continuously talking after a long time. Okay. So the next is market analysis. So, so many people are asking me how I decide the trend, what kind of analysis I do. So I'll just tell you what are the parameters or what are the things that I consider. And some of these are explained in the future slides, but not everything in detail. Because some of these are like available as a different course. Some of them you need to learn separately. It is not wise for me to cover those things here. And there are better qualified people who are specialized in each of these things so that you will get better understanding. Because since I am doing all of this, I may not be an expert in everything, but I consider everything and I give weightage depending on the situation. So here, chart pattern. I said I'm not using any indicator, but I'm using the patterns. So indicators and patterns are different. So I use the pattern. I drill down the chart from the monthly up to the 1 minute time frame to see the patterns. Probably I can go to the trading view. I can show you some of the chart patterns that I consider. Okay, this is the Bank Nifty chart. Okay, so on the Bank Nifty chart, first every morning I go to the monthly. Monthly usually there is nothing significant, but if you look at here, a shooting star pattern is emerging, which you need to be watchful about it. And here, sorry, that was not monthly, that was quarterly. Even monthly also you are getting that shooting star is forming. But it is too early to conclude that it is going to be a shooting star because it's start of the month only. So next weekly, yes, last week was a shooting star in the Bank Nifty spot, which is dangerous. If there is a gap down comes in and if there is a follow-up red candle comes in, it can be a proper reversal candle, which can be dangerous. So it is not a time to become insanely bullish because this is little alarming with high volume. And the next one, if you look at the daily, yeah, daily the trend has been on the upside. And after this chart, we are getting little downtrend. There was a bullish engulfing which got invalidated then with the red candle and the market made a lower low. And here, if you look at the swing high, this could be the immediate support level. So this pattern is what I consider mostly like swing high and swing low on the daily chart. If you look at here, this is the high, and as long as the market is keeping this high intact, I'll keep my buy on dip view intact. But right now, since the market is coming down, I'll be a little cautious. So if you come in the past also, see here, until here the market was bearish. Here in this swing, it did not break this low. So time to think of changing the view, but still not right. And here this swing high was cleared here. So yeah, it is becoming better. But until this it is cleared this high, we can't confidently say it's a trend reversal. So still it is a buy on dip as long as this low is not cleared and this high is cleared. So cautiously optimistic. Again, the market is coming down. This break did not clear this low. Again, it is coming back and clearing this high also. Again, becoming bullish. So then the next few days, this high is also taken off. Then clearly buy on dip, the trend is emerging and it keeps on moving up with intermittent red candles. There is no weakness in the market. Again, sudden dip is coming. That dip is not taking out this low, Maybe here and down it is taking out some lows, but it's not that significant as long as it is not taking out the prior low. And if you look at here, maybe hourly chart, when you split, this can be a swing low, and even that is also protected. Again, it is coming back, another swing down, just 1 day affair. That is not breaking this one. Again, coming back, clearing this swing high, again going up. Here, this high is made, coming down, still buy on dip. This up to here it came, but this one is not good, because without taking this high, it is coming back and breaking this low or even this low. So it is bearish, and then we are cautious and we are looking down. But the next swing did not clear this. Without clearing this, it is clearing this, and so each swing high and swing low, I'm watching very closely, and all the time frame, like daily. Then I look at the hourly. Hourly also I look at the swing high, swing low concept, and then I go to the 30 minutes. Then I go to the 15 minutes, 5 minutes. These are the pre-market study I do. Then during the market hours, I look at the 3 minutes and 1 minute. And I look at the same kind of setup, like swing high, swing low, break and all. Like you see, Friday it was coming down, and from here it stopped making the low. Then it was like consolidating. It started breaking out, and here it broke this high, so it became bullish. I was expecting the market will go up, and this one also broke out. From here also it broke. It reached here, but suddenly from morning low it took resistance, and it got sold off again. This was unexpected in my way of chart reading. So I look at the patterns, head and shoulder, the cup and handle. All these are like swing high, swing low based patterns. I look at those things and I consider those, and I look at the candlestick pattern also. So these things I consider from monthly up to 1 minute pattern, up to 1 minute chart. I look at these patterns. See, higher highs and lower lows explained here. And I recently, maybe a few months back, I started studying the market profile, because they are explaining the market concept really well. And I started looking at the market with the market profile view also. And I look at the market health. I review the market health based on the market profile also. I'm not really only on the market profile, but along with all the other factors, I'm considering market profile. And recently, volume profile also I started looking at. So these are the courses you can study separately, and all the news release, data release, results, etc. And news and data release, most people find it extremely difficult, because you see a positive data and the market is moving negative. You see a negative data and the market is moving positive. And when you look at that, it will be so confusing and so irritating, and you see the market is so manipulated, right? But it's actually not like that. If you look at these things carefully, it is very interesting, because these news release, prior to the news release or data release, what was the move and what was the expectation, what is actually, and even if it is a news, if it is an expected news and unexpected news, and the reaction, immediate reaction and downward reaction, all these things matters in forming the market view based on these release and news. So what I do is, whenever this kind of, I save the intraday chart, like on this one, this is a 3 minute chart, right? So I take the snapshot, I copy this like this, then I go to the Excel, I save it, then I change it to like maybe 10 width or something, and I keep it with me, and I update the date here. So whenever there are like the important data release or any events and all, I update the comments here. So whenever the similar data comes in, I go back and keep on studying such days, the patterns. So when you do that, you can understand most of the time the similar situation results in similar chart pattern. Like you are expecting a positive outcome, but the outcome is negative. And the last few days, the market move was like positive or negative or whatever. So depending, when these combinations are coming together, you are getting mostly identical moves. So it's not that, okay, just because of the data is positive, the market can move up or move down. No, it is not that. There are a lot of other factors which you can understand if you keep tracking and learning and noting it down and revising frequently, you will understand the behavior of the market during these data releases. So most of these data release trades are my big winners because I deeply studied and tracked these things. So those are giving me good results. At what time of the day these moves are coming in, and how long it takes the market to digest the news and make the actual moves. Because certain times the market moves on the headline news. Like the headline news can be positive, but if you read the news in detail, it can be negative. So immediately the market may move based on the positive headline news, but after maybe a couple of hours, the market realizes, okay, there is something hidden negative. Then market actually starts moving in the detailed news favor. So all these things you can practice, you can note down and you can practice and you can check the history. That will help you. And that is the reason I told you after this session, you will not be able to immediately go and plug in, but you will understand more as to what to focus, where to focus, what to study, and how to study. That's what I'm trying to present here. Not that I'll not be able to make anybody right out of the gate profitable, or I cannot transfer my 12 years of learning in one session, but I can cut down your learning curve and I can make you learn what I learned in 12 years, I can make you learn within 6 months or 1 year. So with this guidance, if you apply the proper focus, you will be able to study these things within a couple of months or couple of years time. You don't have to go through all the mistakes that I have gone through, and you don't have to spend a lot of times experimenting and finding out, okay, what is working and what is not working. So that's what I'm trying to do here. And data release news, then global market behavior. So global market behavior, it is most important when there are like global events. There are like war news, there are like Fed events, or there are some unexpected news. Those times, the global market behavior is very important. But on day-to-day, tick by tick movement, I suggest not to put lot of focus into the global market. Okay, Dow is falling, our market will fall. No. Dow is rising, our market will rise. No. Many people are approaching the market in that way, but actually it is not like that. And many times it will be confusing also. But it's always good to keep a track of it because our market is moving up. But imagine US market Dow futures is moving like 500 points down. Yes, definitely there will be a significance and there will be an impact on our market. But it is like a usual range of like 30, 40, 50 points or even 100 points. It is moving up and down. I don't think it is going to make a lasting impact in our market. But if it is a more than usual movement, then it is definitely making an impact. Same goes for other asset classes like currency movement, like USD INR, dollar index, then commodities. Commodities mainly gold, crude, and other stuffs. And if there is an abnormal movement in these things, yes, then you need to consider that. Let's say crude is moving like 10% in a day, moving up. It is definitely going to be bad for the stock market because 10% move in crude that can increase the inflation. But certain times you can see that okay, recession fear is going away, so the crude is moving up. Crude moved up 2%. In those cases, maybe crude and the stock market both may hand in hand move up, right? So all these are like relative things. You need to certain times it is directly, certain times it is inverse. Same goes for the global market also. You need to find out with observation when it is having the direct relationship and when it is having the inverse relationship. And even the crypto market. Crypto market, but off late I'm seeing it is completely detached with the stock market. But earlier I used to say when the stock market was falling, crypto was also falling. When stock market was rising, crypto was also rising. There was a direct correlation, but off late it is completely detached. For the last many months, I am not seeing any correlated movement between crypto or direct or indirect or direct or inverse correlated movement between stock market and the crypto market of late. So I'm not focusing much on that, but other things, yes, always there is a relation, but it is only when there's an abnormal movement, like USD INR. If it is moving like a normal movement, like 0.1%, 0.2%, I don't consider that. I don't even look at it. But let's say 1% move in the currency is like huge. So when there is a 1% move, positive and negative, then yes, we need to be cautious. We need to look at the market correlating that. So any abnormal movement in global market or other asset classes, yes, you need to consider that for analyzing your stock market view or forming your stock market view. Then index heavyweights behavior. So Bank Nifty it is HDFC Bank holding like 30, nearly 30%, ICICI Bank like 25% or something, or 21, 22% or something. Then other banks like Kotak, SBI and Axis like maybe around approximately 10 plus percentage. IndusInd Bank like 6 percentage. And any major news or events on these stocks can impact it. So tomorrow there is something like HDFC Bank MSCI news is there. It is a positive news, but I'm not sure whether it is already priced in because the earlier decision was HDFC outflow will be seeing, but now instead of HDFC outflow, they will be converting that into HDFC Bank. So literally, they may not be doing anything. They may not be buying or selling. But one thing that their expected selling, which would have come next week, is fading away. So because of that, it's a positive news. But ideally, it has to move up. If it is moving up, correspondingly, Nifty and Bank Nifty will have to move up. We don't know, but certain times other institutions which will have to offload HDFC Bank shares because of the merger, they might use that opportunity for selling. So we don't know whether upside will sustain or not. So it's very very critical, very tricky also. So I look at all these stocks behavior also. Certain times one stock may be getting beaten up heavily, that will impact the stock index. Certain times, every stock will be moving hand in hand. That will give huge movement into the market. And certain times you can see the market is trying to move, and some of the heavyweights are artificially getting sold, which may lose control. That can result in blasting move at certain times. So these are the things that you can observe and find out how these are behaving. And don't put all your focus into that, but keep a track of these index heavyweights behavior during the day. So many of these things can sometimes have direct correlation, and certain times these will have the inverse correlation. So that's what I explained earlier. Okay. So just keep track of these things and understand how the market behaves on with the impact of these things. Okay. So that is how I do the market analysis. I put it as bullet